When it comes to investing, retirement, taxes, healthcare, and estate planning, the decisions you make today can greatly affect the quality of life for you and your loved ones tomorrow. What you need is straight and unbiased information on the most important issues you'll face when planning for your retirement and financial future. Good news, you found Premier Retirement Radio with Jeff Vogan. Jeff is the founder of Premier Retirement Planning and Wealth Management, and he's been guiding people financially and into retirement for 30 years. So get ready for an hour of the most comprehensive financial information on the radio. Premier Retirement with Jeff Vogan. And now here's Jeff Vogan and Jeff Shade.
Thank you so much. Welcome to Premier Retirement with Jeff Vogan, the radio show that gives you the straight talk and honest answers you need to reach your wealth management and retirement goals through smart investing and careful planning. On today's show, we're going to be talking about how retirement planning is more complex than it was 5 to 10 years ago. We'll also answer listener questions and then talk about set it and forget it. Well, that's how you run out of money in retirement. My name is Jeff Shade. As always, I'm just here to ask the questions, but the words of wisdom and solid advice that come from the other Jeff in this radio program. It's Jeff Vogan, founder and president of Premier Retirement Planning and Wealth Management. Jeff, how you doing today?
Always doing good when I'm with you and the listeners. It's a fun day.
Yeah, it is for me as well, too. We've got a great show lined up for folks. I'll start by giving the phone number, 520-780-9059. As you hear the program today, if there's anything that piques your interest, you want to come in and have a further conversation with Jeff, you can call 520-780-9059 and request your Premier Retirement Roadmap. Jeff, today we're talking about something a lot of people feel but can't quite define. Retirement today is nothing like it used to be. No gold watches, no guaranteed pension, and yet people are living longer than ever. So the big question is, how do you make your money last when retirement could last 30 years or more? So let's start there. Why is retirement today, Jeff, so much more complicated than it was for our parents?
Well, there's a lot more choices to make. For one, our parents typically had a pension, so they always had their income made. They didn't really need to worry about it. It was kind of like they didn't worry about whether or not they had to take risks or diversify a portfolio. They didn't have 401ks back in that day. I mean, they're kind of phasing out, or they're phasing in, and the pensions are phasing out. So that's the main thing. I think just the income security is the biggest lack, and people have been able to figure that out by and large, but many people haven't figured it out. Some people think that the same strategies that get you to retirement through investing in the stock and bond market is the only way to go because that's how they grew their wealth. And then during the retirement years, you never know what the market's going to do, fluctuating up and down and bouncing around, and volatility sets in, and it kind of ruins an income plan. If you really do the math and you look at how those market cycles will treat an income plan, it's certainly not safe and secure and providing the peace of mind that some sort of a pension does. And that's why people need to think about that and take some of that 401k money and build their own pension. So, in the old days, I say the old days, it's funny, my grandkids, my kids always ask me, Dad, tell me about stories about the old days. It's like they're not that old. But for us, we're still growing and kind of preparing for the golden years and the retirement years and so forth. But things are a little bit different. There's so many more choices. There's so many more options. They didn't used to have things like private equity. They didn't have annuities that had income plans where you could actually have control of your balance of your account and change your mind on the income if you didn't want income for life. You didn't have to just say, gee, do I want to park my money here, or do I want to take a guaranteed income? Gee, how do I want to deal with this? And, it was kind of not a lot of choices then, but now we have those choices. So it is more difficult. The good news is that there's an abundance of information. There's people out giving classes at colleges. They're doing classes at libraries. They're doing seminars, educating people about different products and services. Obviously, they go out there, and we do that too, and educate the people about ideas that they might not know about. It introduces them to products and services that they might be able to incorporate into their own plan. But I guarantee you, your 401k guy isn't going to do it. Your mutual fund guy isn't going to do it. Your advisor that only does stocks and bonds isn't going to do the comprehensive planning. They're not going to tell you about it. So for some people, maybe it doesn't seem that complicated because they think it's just stocks and bonds, and what gets them there gets them through retirement. Those people that are starting to educate and look online and just read the amazing amount of information that's out there either get confused or they get educated and they kind of know some directions that they want to consider. Thing is if you're doing it the first time for yourself, you're a novice going into the retirement planning business. And I would suggest that because it's getting more complicated, because there's more choices to make, because you're more in charge of your income and you're in charge of making your own security in your retirement. And retirement's maybe a decade or two longer than it used to be. When Social Security first came out, the average life expectancy was basically Social Security age. So half the people weren't even supposed to get a check. Now everybody's getting a check, and it's not just for a few years, it's for a few decades. And that's what's putting a lot of strain on the Social Security Trust Fund, which is another complication. Can we rely on all that money that we put into the trust fund, and can we get it all back? We can't get it lump sum back and do our own thing with it, but we can hope we get the income from it, and we may or may not. So now there's another thing to think about is how do we make up the income if they do have to adjust Social Security? Just all kinds of different things that I think didn't exist. And again, the more things that exist, thankfully we have the internet that gives you an opportunity to self-educate and to at least find out what kind of questions there are that you should be asking. If you don't like sifting through all that information, when COVID shut us down, I wrote a nice little book about what questions you should be asking. It's called Retirement: The Road Ahead. Ask better questions, get better answers. Listeners can get that just by logging into the website and downloading it free. You can go to Amazon and buy it for $10 or something. But we have a few copies left here. If you come in for an appointment, you can have a hard copy if you want to come and kick the tires around here. But that's a good book to just help you ask the right questions. And once you start asking the right questions, you can either research the right answers, or you can find different advisors that might have expertise in those areas, or go to more of a comprehensive planner, more of a holistic planner like we are, and talk about how all those things fit in specifically for the retiree. We don't do everything for everybody, but we're really good at retirees, and we think we do everything for retirees. And I don't know that we have everything under this roof, but we know what roofs, where the other things exist. And so we're really good at quarterbacking the team and making sure that we get a game plan that works, and we can run it pretty effectively after we've been doing this 40 years now.
Well, Jeff, I think the biggest change in retirement planning from when our parents retired is that when our parents retired, many times they had Social Security, but they also had a pension. That's something that people do not have anymore. Only about, I'm going to say, under 10% of people have pensions. So how do you create a pension-like income for someone to supplement Social Security if they've got nothing else?
I mean, hopefully they have savings and retirement plans and something that they've set aside, maybe even home equity. I guess we'll talk about that. If you've got some assets, but you just don't have income plans, and you can take a portion of those assets, the 401k or the savings, the investments, maybe you have a rental home you're able to collect some rent from. That's a nice little income stream, but you're working for it. That's actually not passive income. It's a job. So you might want to consider moving some of those assets into what I like is annuities or LIRPs, life insurance versions of an annuity, where you get income, guaranteed income for life on an annuity, regardless of how the market performs. If the market does well, the annuity does well. If the market doesn't do well, the annuity stays the same. At least you don't lose money. And if you lock in income on those annuities, the income is guaranteed for life if you set them up correctly. And I like the ones that are not annuitized. You can get those at a bank, or you can get those at brokerage firms. And I don't really like them. I think they're purposefully selling what I would consider bad annuities so that you'll hate them and you'll keep your money in mutual funds. Also, you kind of lose control over your money when you do an annuitized annuity, meaning you give up money, you get a pension, an income stream. If you die, the money's no longer yours. It goes to the company, and they pay those people that live too long. And if you're the one that lives too long, then you get somebody else's money. You live on dead people's money. If you're the one that dies early, then they live on yours. So I don't like those kind of annuities. I like the ones that have income riders, meaning that you continue to get the growth on your own annuity. If it continues to grow, your income can stay the same or even increase. If somehow that account runs out of money before you die, you continue to get the income from that account. And if for some reason you pass away early and there's still money in the account, then your heirs get that money. Your spouse can use it. The spouse can turn that on for income. Or if you have a joint income, the spouse can continue getting income, whether there's money in the account or not. But you have options. If you get sick and you don't have a lot of longevity and you have a nice balance in that income account, and you don't think you're going to live another 100, live to age 100 to get all the income that you want out of it, then you can actually take advantage and cash that account balance and use it for your long-term care. Use it to move into a nice assisted living facility or Splendido or these nice upscale places where you can continue to live your retirement on your terms and have a little bit of luxury in it, instead of just some sort of I hate to just sound morbid, but a wait and die approach where you just go in and pass the time and spend as little as possible. I mean, if you still have access to those accounts, then you have choices. Whereas in the old school annuities, which has given annuities a bad name, you don't have those options. So a step up from that might be one of these annuities in a Roth IRA account with some of your IRA money, which gives you tax-free income, or a LIRP, life insurance retirement plan, where you actually buy a life insurance policy where if you die early, you get a nice death benefit for your spouse or loved ones that might outlive you. And you get tax-free income by way of loans against the policy rather than taking the money out of the policy. The difference between a Roth and a LIRP is a Roth, you actually reduce the balance every time you take a distribution. You also get 1099, so the IRS knows that it's income at this point. That income is not taxed, and it doesn't at this point that I know of affect any of your means tested benefits, like a little extra, less tax on Social Security, some of those bonuses, lower costs of Medicare premiums on your IRMA, the Medicare Part B's that everybody has to buy. And that goes up the more income, the more provisional income you have. So far, Roth IRA doesn't affect that, but it may in the future. The LRP does not, because it shows up as a loan. It doesn't generate a 1099 and it doesn't ever look as income. It's basically you're spending your death benefit early. So again, you can create income with a portion of your assets. And I mentioned that if you don't have assets, maybe you've got equity in a home. People that have $600,000 or $700,000 of equity in a home, you can consider that a bank account really, because you've already put your money in there. And it continues to grow probably by 2 or 3 or 4% a year on average, sometimes 10 or 20, like a few years ago during COVID, we had a little spike, but things are settling down. It's going back a little bit more to reality and real estate prices are holding their own. But the bottom line is that is money you could spend. You can do things like reverse mortgages. I have very wealthy clients that do reverse mortgages because their kids are set or they have no kids. They don't care about making anybody rich, but they know they put that money into their home. And I've got one client that has about $1.25 million in home value that she's borrowed against, spent probably 900 of it, which has grown to about 1.2 million. And that happens to be what her loan's worth. Guess what? When she dies, she can hand off cash and nobody has to even sell her home. Actually, they should, because there's still a little bit of equity in there. But bottom line is she's been able to live comfortably by having an extra roughly $8,000 a month in income. And she still has more than $1 million in cash accessible if she needs a lump sum. But you can't go to a nursing home and then all of a sudden decide to go get a mortgage on your house. That's going to be a little difficult when you're considered, on your last legs and considered invalid or considered possibly mentally incompetent. So again, it's something that you do beforehand, but you can create pensions out of any asset you have if you don't have a pension and all you have is Social Security. But I would suggest that if all you're doing is the only steady income that you're counting on is Social Security income, to rethink it. Not because I think Social Security is going to stop paying you, but I know the trust fund will go broke and they're going to have to decide how to make Social Security payments based on about 75% of input to the account compared to the money that's outflowing. So there's going to be about a 25% deficit. I have a feeling, this is just theory, but I have a feeling, and I'm not the only one with this feeling, is that it's going to be means tested. So maybe if you're poor, that's all you're living on, you'll probably be able to keep the full value of your Social Security. If you're even more poor, maybe you get a little bonus, but the people that are considered rich, the mantra, tax the wealthy, tax the rich, they're not paying their fair share. Well, I'll bet they fix Social Security eventually by taxing the rich more than their fair share, because even though the rich people have put probably more into Social Security on a percentage basis, they get less out than the person that put in, let's say, half the max of Social Security. And yet we're continually paying into it on a higher basis, especially if we're continuing to work a little bit through retirement and we still get income. We still have to pay into that Social Security, even though we're not going to get more out of it. Somebody else is. So I think it'll be means tested. I think that's something that we need to worry about. And you need to have some extra income sources that are guaranteed if you don't have pensions that are safe and guaranteed. And by the way, check your pension out. Some of the pensions aren't as safe as you think. I'm not even going to name names because some of them happen to be here in Arizona, but there are some pensions that are like in the 45th out of 50 states ranked as far as safety and stuff. And they're doing games like letting people defer their income to buy up more pension and things like that. I think it's really more of a Ponzi scheme. They're really just doing that in order to cover their present needs and not really sure how they're going to solve the problem 20 years down the road. But that needs to be looked at. Now, the nice part is if it's a state or government run type pensions, typically because of taxing authority, they're probably not going to go broke. But then again, somebody's going to be taxed for that. So tax planning is very important from that standpoint. You don't want to be having to pay everybody else's pension, especially if you don't have enough to have your own. But make sure you have your own pension, whether it's a private pension that you've set up yourself that's guaranteed by something as solid as an A+ rated, super strong insurance company with reserves and surplus and even insurance behind that. Some pensions have a pension guarantee fund that makes them safer, and some are just kind of going on their own, hoping that they continue to take in as much money as they pay out. And if you do have a pension, check on the strength periodically and make sure that you can sleep at night, because that's an important set of income. And if you can't, maybe develop a couple of extra streams of income that you can count on, because the rainy days will come. They haven't come as soon as I thought they would. You've heard me on the radio for a few years saying, we're really overvalued. Now, I'm not the only one. Warren Buffett's still raising cash. I think his cash reserves in Berkshire Hathaway is up to like $370 billion out of a little over $1 trillion in assets. So he's continuing to raise cash. He still doesn't believe in buying stock at the prices that it is. We're a little bit more nimble, so we're dabbling in it and doing okay. now. It was a lot easier the last couple of years, but it looks like maybe the gas is running out. And so we need to be careful that some of those profits that you've gained over the last few years, you take off the table, you make income out of it that you can count on, and don't sit and let it risk it in the market and have it reset through another market correction or a crash that loses you 50% of your money and it takes 10 to 15 years to get back to even. That's, by the way, what it did take. It took between 14 and 15 years for the NASDAQ in 2000 to get back and stay above its prior high point in the year 2000. So it wasn't until 2014 and 15 where you finally got back to even. So if you want to work another 15 years trying to get your million back that you lost, that's not really a happy thought. And the fact is, it can happen. Some people think it can't happen because the government will just keep printing money, but I don't know. The market is pretty big. It can do things that even the government can't intervene and just instantly stop. It may or may not be able to help, but you never know. We'll see what happens. I hope the government can kind of manipulate us out of a market crash if possible, but it's been printing money, and that's just a recessionary end game eventually, and an inflationary force that comes into play, and that's not good for retirement either.
Talking with Jeff Vogan of Premier Retirement Planning and Wealth Management here in Tucson and Mesa, and we're talking about how retirement planning has changed in the last 10 years. If you've been listening to the program today and you're realizing that retirement is more complicated than you thought, you're not alone. The truth is that most people have not done the math, and that is exactly how they end up running out of money later in life. And that's why Jeff and the team here at Premier Retirement are offering you a no-cost Premier Retirement Roadmap, absolutely no cost and no obligation. They'll show you where you are, where you need to be, and whether there's a gap that could put your retirement at risk. If you would like your plan, again, no cost, no obligation, 520-780-9059 is the number. You can make that call right now if you want, 520-780-9059. You can also find out more about us online at premret.com. Jeff, you have been in this business, retirement planning, for more than 30 years. What is the biggest change that you have seen in the tools and products that you can offer to your clients as opposed to maybe 10 years ago?
They're a lot more user-friendly, I think more retirement-friendly, a little more tax-friendly in some cases. I think the industry has come up with plans. For example, they fixed annuities. I was talking about the old school annuities that give annuities a bad name. That's where you walk away from your money if you die early, which is typical of any pension. The nice part about annuities is they've given you options now where you can pull your money out, park it there, and still have control of the balance of your account, even though they're guaranteeing you income off of that account for life. And if somehow the account runs dry, you continue to get income. It's called an income rider. Those started, I'd say probably in the early 2000s, 2010, they got a little bit more hot and heavy and becoming very creative and a lot more fun now. We've also got indexed annuities that go up when the market goes up and don't go down when the market goes down. They're principal protected, so that gives you some options. They have some buffered annuities, which I don't like as much. They typically have high fees like a variable annuity, but they limit the downside to maybe 15%, but they also limit the upside to like 15%. So that doesn't seem like a even game, especially when there's small losses. Now in a 50% down market, that might be a good thing, but typically those strategies also make you wait anywhere from 3 to 5 years before you actually get the calculation to pay you what you're supposed to earn. So I like the fixed index annuities that are principal protected. I like the fact that LIRPs now play the same game with Index Universal Life. There's some creative ways that insurance companies have priced LIRPs, life insurance retirement plans, where you can actually, it kind of sounds counterintuitive, but you actually overpay for insurance, which means you have to buy less insurance so that they can give you back that money when you borrow against it. And so they give you more money on the backside, but it actually reduces the cost overall. So, I mean, there's been some creativity in how companies, and that might sound like I said counterintuitive, they don't really overprice, they underprice, they just level out the premiums that you pay up front into more income over the future. So you can do the math, see if some of these things are exciting for you. There's also a lot of access to private equity. It used to be that you could buy REITs, real estate investment trusts, but the management teams usually took all the profits and laughed all the way to the bank while they left you hanging, and you might or might not get all your money back. And REITs have kind of got a bad name. There's a few that are publicly traded that have become winners, but those are few and far between, in my opinion, over the ones that I've seen over the years. But there are private equity firms that they'll actually build a ticker symbol. We have access to a few that have done relatively well. They pay about 11 or 12% dividends sometimes. Basically, it's profit sharing. But, you know, if they have a default, you might lose 5 or 6 or 7% on the value. But again, if you're getting 12 or 13% on the dividends, you're still at least break even or up a little bit on the bad years if something happens. But generally speaking, you can make more than a CD. You have a security typically secured by real estate lending, factoring loans and things like that. Sometimes it's just short-term lending programs that provide capital for companies that can't go through the underwriting time frame of a bank, and private equity can usually do that quicker. So private equity, things that were generally available only to multimillionaires and billionaires and family banks and things like that, are now available to accredited investors. Now, that still means you typically need to have $1 million in assets or $250,000 or $300,000 income in order to be an accredited investor. But more and more people who are retiring have $1 million. That seems to be kind of a very common or minimal amount nowadays. At least the masses seem to have millions, not a few $100,000 trying to make ends meet. Because they don't have pensions, they've been able to accumulate a lot more wealth in 401ks and IRAs for a lot longer period of time. And now you can convert those things into some income producing assets that don't have to do with government bonds at 4% that might go down if interest rates go up, or might go up a little bit if interest rates go down. They're a little bit more secure. They have assets that are backing them, and they pay a little bit more. I mean, shoot, some of these holdings at some of these big private equity companies that you can actually participate in have a 20% ROI. Some of them have 4 or 5, but they're steady. Combining them all up, maybe 8 to 10 or better, is available in some cases. So again, it's not for everybody, but I'm just reaching out. You asked me what's different. The difference is it's not just stocks and bonds anymore and a few bad annuities, maybe a little bit of life insurance. Now it's creative annuities, a million different types of flavors. I mean, talk about 31 flavors of ice cream with Baskin Robbins. Annuities have like thousands of flavors, and the choices are probably daunting if you try to dive in and analyze them. Fortunately, through software and through wholesalers and brokers and stuff, we can get a lot of information and whittle down the 2,000 companies that sell annuities into maybe 30 or 40 that we like. And then of those products that they sell, maybe 5 or 10 of the best that we have for different reasons at any given time. But we have access to sift through the mess and run through the maze and come up with the best alternatives. And unfortunately, some people who don't know the ins and outs of them just go with the first one they hear. And it might be some guy that only knows about one annuity, and it's the end-all cure-all for everything, and they end up with it, and it's really not the right product that they could have gotten if they'd shopped it around a little bit, or used somebody like us who shops those things around. LIRP's the same way, life insurance. Also, there's a lot more software that builds tax planning scenarios, Roth conversions. We use several of these programs to back our own theory up. We've been using our own spreadsheet and kind of come up with a plan that works. It's interesting that all these new software programs come out and it says, well, your ideal time frame to convert this Roth IRA to the exact penny is like 4.7 years. And our plan, it was 5 years. So we weren't too far off, even not winging it. We weren't winging it. I mean, we can see by the spreadsheet, we can change and play with the numbers until we get the best year to do it. But we do have backup software. There's a lot of things that people can use now, or find advisors that have things that can analyze what they're doing and make them feel a lot more comfortable about it. So instead of just going into retirement planning with a stock and bond portfolio, believing that all you can do is take max 4% out, or you might run out of money, you can find out that through creative allocations to annuities, LIRPs, and other things, you might be able to get more of a 7 or 8% payout rate and still be guaranteed not to run out of money. And in addition to that, still have some play money that you can throw at the market and try to hit some home runs and try to buy the next NVIDIAs and the next AI hot stocks and things like that. So, if gold and silver ever get hot again, maybe we'll jump back in there. And oil, who knows what that's going to do. This war in Iran has really got that market topsy-turvy. I think there's a lot of insiders make a lot of money on options on that one. So the market's being a little bit manipulated. We need to diversify outside of the market into those products that give us peace of mind and can actually create higher guaranteed, higher predictable income and tons of tax savings if we do it right through LIRPs, Roth conversions, and other tax planning strategies that we employ on a daily basis.
Talking with Jeff Vogan of Premier Retirement Planning and Wealth Management here in Tucson and Mesa. And we're talking about how retirement planning isn't what it used to be. And it is a very good thing. As I said, it's not your father's retirement plan. It's smarter, more flexible, and built for the life that you actually want to live. If you got a retirement plan, let's say 5-10 years ago, or maybe in the last couple of years, and you're not sure whether it's keeping up with today's environment, again, we invite you to call Jeff at 520-780-9059 for your no-cost, no-obligation retirement roadmap review. It's 520-780-9059. You can also find out more about us online at premret.com. It's premret.com. Jeff, time for a break. When we come back here on Premier Retirement, we're going to be answering listener questions, and then we'll be talking about set it and forget it. That's how you run out of money. When Premier Retirement continues here on 790 KNST, Tucson's most stimulating talk.
You can't start a trip you've never taken without a plan, and you can't start your retirement journey without a comprehensive plan to get there safely. To request your no-cost Premier Retirement Roadmap, call 580-780-9059 or request it online at premret.com. Now back to more Premier Retirement with Jeff Vogan and Jeff Shea.
Thanks so much for joining us this fine weekend for Premier Retirement here on 790 KNST. My name is Jeff Shea, joined by Jeff Vogan, founder and president of Premier Retirement Planning and Wealth Management here in Tucson and Mesa. We're on the air for you 4 times a week here on KNST, Saturdays at 7 a.m., 9 a.m., and 1 p.m., also Sundays at 11 a.m. And as always, we're on the air for you as far as our podcast goes, 365 days a year, 24 hours a day, 7 days a week. Go to wherever you get your podcast, search for Premier Retirement with Jeff Vogan. You'll find this show and many of our past shows so you can stay on top of your journey towards a confident retirement. Our phone number, 520-780-9059. If you hear anything in the program today that piques your interest, you'd like to come in and sit down and talk with Jeff, get your no-cost complimentary Premier Retirement Roadmap. Again, it's 520-780-9059. Okay, Jeff, these are the kinds of questions that we hear every week. People who've done a great job saving, but now they're asking, what do I do with the money? So Danielle is listening to us in Marana, and Danielle says, I'm a 58-year-old single parent with 2 children. I have $720,000 in retirement accounts and $590,000 in an individual brokerage account. I work for myself and my salary fluctuates between $80,000 and $170,000 a year. I don't plan on retiring until after 70. My expenses are $100,000 a year. I also have an $80,000 mortgage on a $900,000 home. I'll inherit my parents' $1 million home plus $450,000 in a regular brokerage account. My parents' broker charges them a 3% fee, and this broker does not achieve returns better than the S&P 500. I have a few questions. Should I sell the home? Where should I put the money? Do I rent the home even though it's across the country? And I'm also unsure about what to do with the $450,000 in my parents' brokerage account. What do you think, Jeff?
Well, yeah, I think the first thing that jumps out at me is a 3% fee. I'm not sure if that's 3% just to the broker. That includes all the other fees like the mutual fund fees and other things. I've seen 3% easily on some of these, I hate to say it, but even some of these advisors that work for companies like Fidelity. And they'll sell Fidelity, they'll reduce the fee, but they'll sell them mutual funds that have mutual funds in them. So you've got 3 layers of fees and it adds up to 2.5 or 3%. So maybe that's what you're talking about. And typically they don't receive better returns because it's from a big market maker. That company is basically just keeping up with the market at best, minus cash drag and some other things and internal fees, trading costs and timing issues and so forth. Very rarely will beat the market. And then you've got all these layers of fees off that. So yeah, it probably doesn't keep up with the market if it's in aggressive things. The other thing is maybe the 3% fee is more of a hedge fund type thing where they have access to different markets, maybe some private equity and things like that. And maybe they don't keep up with the market, but maybe they have a lot more downside protection. If we look at our overall portfolio, we won't beat the market. Now, our managed funds have consistently beat the market over the last few years as far as our aggressive funds compared to aggressive funds, but our safe funds are keeping up with the safe funds. But overall, we've done well on the managed money. But if you look at the overall plan, probably not, because we have principal protected assets that are providing income or don't go down when the market goes down, and it's a lot more stable. Now, your money will last a lot longer with our plan. But, if the market has a super good year, we're going to do great on our managed money, very likely. But we're not going to do as great on our safe money. But if the market goes down, we'll try to manage the risk in our managed accounts, but the other accounts won't go down. So in that case, if market plummets 50%, and let's say we're down 15% on a 30-year money, we're down 5 and the market stays even. So we're down 5, the market's down 50. I mean, that's a pretty big margin. And I wouldn't say we'd charge 3%. I mean, you'd have to try real hard. Anyway, that just seems a little excessive, but it doesn't seem abnormal. I mean, unfortunately, there's too many ways that even you get a portfolio of variable annuities, you're paying 4 or 5% sometimes. Plus, sometimes the guy's charging you a fee too, the money manager. So that was the first thing that stuck out. But based on the fact that you're a 50-year-old single mom, good for you. Glad you've been saving. You've got a good job. It does fluctuate. There's a couple of things that jump out at me right there. You ought to be considering, especially with some of this, you probably have a lot of surprises in the $590,000 brokerage account, because if it's not just park and hold stocks, if you're doing any kind of trading or mutual funds, you're going to get a 1099 for gains on that. And sometimes that'll increase your income, and possibly in a good year, it could increase your taxable income over, say, $200,000 a year, which would put you in a higher than a 24% tax bracket. So I'd consider, even starting at 58, considering you might retire in 5, maybe 10 years, depending on how long you want to work, is maybe putting a third or 2/3 of that into something that's either tax deferred or a little bit more tax friendly. Maybe even try alert for some tax-free income that might generate you $40,000 or $50,000 in tax-free income a year when you retire. $40,000 or $50,000 tax-free plus your Social Security. Don't know if you've got a job where you can just work part-time. It sounds like it's probably your income range looks like a real estate person. So maybe you want to do that part-time and still get a little bit of side money there. But between that and then the $720 in retirement accounts, if you want to start taking profits off the table, I think you should. There might be another $40,000 or $50,000 in assets that you could turn into an income stream, another $40,000 or $50,000 in 10 years, probably even more than that. But I can see you locking in at least $100,000 to $120,000 just on the accounts that you own if you don't get greedy and really swing for the fences and try to get the upside, because you can get some upside with income plans without having any downside. And I think you've saved enough to where you can really lock in a good retirement with what you have. The other thing is, if you got $100,000 in expenses a year, like I say, you're going to be over that even without Social Security. And I'm sure, unless you've got an S Corp, maybe you've found a way not to pay into Social Security, but I hope you do. If you're going to retire after 70, this gets even better. I mean, you could probably do it in 5 years, but if 10 to 12 or 13 years is more realistic, I just don't see you having a problem if you can live on 100 in today's dollars. You can inherit $1 million home. Honestly, real estate, long distance, I haven't seen that work out very well unless you're going back and forth using it. Maybe you've got a great manager. You can Airbnb it, maybe if it's in a nice place, or rent it out. Honestly, you could probably turn that into another $60,000 or $80,000 in retirement income if you do it right. And then your brokerage account, again, you could continue to add that money to things like LERPs. You could also look at your taxes every year like we would do. If you were our client, you'd be coming in, and depending on what you'd made that year, we decide how to maximize that $200,000 range of income and do some Roth conversions from your retirement accounts and pay those taxes out of your brokerage accounts. That way, all the money that you convert stays in the retirement accounts that are tax-free. Grow those and turn the taxable income into tax-free income in retirement. Or you have a storage account where you can just continue to grow that, not touch it, and let that be your tax-free legacy to your two kids. I see a lot of things that if you see this on a full plan and anticipate reasonably close to when that inheritance will come in, I don't see you, again, I see your ambition to work to age 70. You must have a job you like, a business that you like. That's awesome. You're going to be fine, in my opinion, if you're living on what you're saying you're living on. But you're not going to be fine if the market takes a dump and it goes down 15 or 50% like it did in 2000 and it did again in 2008. And if, like in 2000, you've got a lot of high-risk stocks like the NASDAQ, took 14 years to come back, and you might barely be back to where you are right now when you're 70. At that point, it might be a little stretch to try to make what looks like $100,000 a year in expenses today be covered based on 14 more years of inflation and cost of living expenses, things like that going up. So again, I think you're in good shape. You should start taking some profits off the table, creating some future income streams that you can count on, and not just bet on a market that you can't control, that you have no crystal ball on how it's going to perform. You just have historicals. And if you're gathering assets and trying to accumulate assets, that's fine. But if you're within 10 years or less of retirement, you might say you're going to work 10. That might give yourself a chance to lose money and make it back, but it doesn't grow your money on a guaranteed basis for income. I think that's something you ought to be starting right now.
Danielle, great question. Thank you for listening to us in Marana. And again, if you'd like to further the conversation with Jeff, call 520-780-9059. We would love to talk to you. Next question. Jeff, is Scott listening to us in Catalina Foothills? Scott says, I'll be 45 this year and I'd like to retire within the next 5 to 7 years. I have $3.2 million in total investments. Of that, approximately $506,000 is in a Roth IRA, $197,000 is in a rollover IRA, $36,000 in a Roth 401k. The rest of the money is invested in stocks and mutual funds with $80,000 held in cash or cash equivalents. Now, as I said, $3.2 million in total investments. Scott says, I'm wondering if I have too little invested in retirement accounts as part of my overall portfolio.
I don't think necessarily you do, but what you do have is those brokerage accounts outside. You've got close to $3 million, and you will have at least that probably when you retire in a few years. So the problem with that is it's always surprise income if it's invested or if you're doing any type of trading at all, mutual funds and so forth. If you're just on a buy and hold basis, you're still taking profits out of that. So depending on what you decide to live on, and I'm assuming that if you're 45 this year and you've got $3.2 million in assets, you've done well and you're making multi-six-figure income now, you're probably going to want to continue to live on that. I don't have a problem with you not having that much, especially deferred IRA stuff. So I'm in the business, and I just think that's kind of just a kick the can down the road tax plan. But if you've been in a high income bracket, You might have been able to use some of maybe a little bit more IRA deductions or 401k deductions. Not sure at your income level, investing in a Roth 401k was smart at this point. I think it would be really smart in the next 5 to 7 years when you retire, and then you start doing some Roth conversions at that point. You don't have enough 401k or IRA money that's not in Roths already that is going to cost you much of a tax hit in those few years. I think you ought to really consider the non-qualified Roth alternative, and that is LIRP, Life Insurance Retirement Plan. At your age, you could probably create yourself a couple $100,000 easy in tax-free income in retirement, stealth income. It wouldn't even show up on your tax returns, and you'd be really happy you didn't have a ton of IRA money generating a 1099 every year and generating guaranteed taxable income. The other thing is, the nice part is the only reason you can retire at 45 or 50 and not wait to 59 and a half is because 401ks make you wait to 55 before you get penalized on taking withdrawals. IRAs make you wait to 59 and a half before you don't get penalized on withdrawals, unless you take what's called a lifetime 72T income. That's just the IRS code for just kind of a life expectancy income level, which is minuscule if you want to have fun while you're in your go-go years in the 50s and 60s. So you are set up to where you could do a lot of really good things with you that are very tax advantaged. You could just park some of that in some things that give you a tax deferred guaranteed growth rate and kind of ladder that type of a thing, kind of like a laddered bond account. But the nice part is you don't pay tax on it as it grows. You only pay tax when you use it. And that is actually through what we call MIGAs, multi-year guaranteed annuities. They pay more than bonds. They're tax deferred. They're just as safer probably. And the insurance company that offers these multi-year guaranteed annuities, they take the risk on the bond values. I mean, if interest rates go back down, yeah, bonds could go up. But if interest rates go up, bonds could go down, and interest rates could go up. We still have inflationary pressures. The government's still printing money. They're still trying to keep us out of recession. They're still propping up the market. They're doing a lot of things that are somewhat inflationary, and I think could come back to bite us in the rear if we're not careful. So getting some of that money in safe income producing places for the next 5 to 10 years might be wise, but you want to ladder them so that when you take that money out, it's probably after the 59 and a half years, and you create some sort of an income plan that'll get you to retirement, the normal retirement age. So you've got about a 10-year income plan to create out of those assets. That's tax efficient. I think it's easy to do based on the assets you've saved. And I think you'd be pretty comfortable saying that you could live on a good $250 a year pretty easy for the rest of your life if you do it right.
Scott, thanks for listening to us in Catalina Foothills. And again, 520-780-9059 is the number if you would like to continue this conversation with Jeff. Okay, Jeff, Carl's in Rancho Vistosa. Carl says, we moved here from California and I sold a business in California, and now we have a sizable taxable portfolio. $4 million. I'm 64, my wife is 63, and we're here for retirement. What is the smartest way to reduce taxes on investment income moving forward?
Okay, so your taxable portfolio, $4 million, I assume you already paid the capital gains taxes on the business that you sold. If there was any, you probably depreciated a whole bunch of things. So hopefully that's your net. If not, you probably have more like a little over 3. But that $4 million, you could put half of that in something that would generate a couple $100,000 in tax-free cash. You could put another $1 million or so in something that'll just grow for the future, another $1 million in some tax-free laddered annuities like I was talking about. I don't think you should risk everything in the market. You've sold a business and you should create at least a nice income stream from that. I'm not sure what that $4 million generated in net income, but I'm guessing probably a couple $100,000, I'm guessing, or maybe more. You could probably get that based on your Social Security and based on what you could do with investments, safe investments. You could generate that kind of cash flow. There's several different ways to generate cash flow. The problem with $4 million in assets, if it's all in mutual funds, let's say, and because of all the trading and turnover, you have a 20% year, all of a sudden you're paying tax on $800,000. You have a 10% year, you're spending tax on $400,000. That's nice, but if you have to pay tax on that and you're not getting income from it, maybe there's a way to grow that asset in a tax deferred basis account and use some of your principal instead of just paying tax on the interest all the time and using part of that. So again, depending on what your goals are, if you're okay paying taxes because you make a lot of money, then you could invest aggressively and probably be okay, barring a big market correction. But again, depending on how much you're willing to risk is another story. If you had a business, and I don't know what your other assets are, if that's where all your assets were, you're probably not at a point where you want to say, oh, let's just jump in the market and do this for the first time when the market's at an all-time high and continues to create all-time highs. Is that good? Well, it means the trend is up, but doesn't mean it's necessarily a great time to buy. I'd prefer to buy at an all-time low, but it's not going to ever get to an all-time low because all-time lows, but we're going to get to like maybe a 10-year low or a 20-year low. That's a great time to buy in or be very vigilant on your investments. or make sure that you have some long-term investments that you're okay to wait on, even through a market correction, and that you can create income from some of those dollars. So again, unless I know what your real lifestyle requires, unless I know how much tax savings you want, how much you want to leave for your heirs, how much you want to spend, and what your other assets look like, it's probably hard to build a plan from that. But I would look at your future tax situation. You've already paid tax on the $4 million. How do you get out of the taxes on the ongoing increases from that, or at least use that money in the most tax efficient way so that you don't have to swing for the fences and hit home runs every year, because you're not going to. The market just doesn't do that every year forever. It does it some years, and it'd be nice to have that access sometimes, but not have all your money sitting on that bet. So kind of vague here, but that's because I don't have a lot of information to go on. But again, you got a nice little nest egg. I'm sure you can make ends meet and live on a decent income, probably similar to what you were used to before after having sold your business. Maybe even get a pay raise. I don't know.
Carl, great question. Thanks for listening to us in Rancho Vistosa. Once again, if you want to further the conversation with Jeff, 520-780-9059 is the number. You can call that number right now this weekend. Leave your name and number, and Shelley will set you up with that appointment with Jeff, 520-780-9059. Listening to the program today, you want to sit down with Jeff on an individual basis, have a casual conversation about your particular retirement journey. Again, you can call 520-780-9059. There's absolutely no cost and no obligation for this review. 520-780-9059. Jeff, I want to talk about the set it and forget it mentality. That's how you run out of money. And you know, a lot of people believe that once they retire, the hard part's over. They think, I've saved, I've invested, and now I just want to sit back and let it ride. But what if that mindset is exactly how people end up running out of money? Well, let's break it down why retirement is not a set it and forget it situation. So let's start there. Why do so many people, do you think, believe that retirement can just run on autopilot? I got the retirement plan a few years ago, and now I'm just going to let it ride.
Well, it depends what your plan is. I mean, we do a lot of autopilot plans. I have some clients that don't even come in for annual reviews anymore, but it's because they have income on autopilot. It's guaranteed and never going to go away. The autopilot that I think the set it and forget it mindset starts when people accumulate assets during their working years. They park it in the stocks and bonds. They keep adding to it. They don't think about it. It just keeps on growing. And by golly, they've got millions of dollars when they retire. Woohoo. You know, is that great? Or even hundreds of thousands of dollars or tens of millions, whatever it is. The mindset comes from those working years. Save, contribute, don't touch it. It'll be fine. But then retirement flips everything. Now it's about creating income. What have you built? How do you get income from it? Now, if you're our client, probably a half to 2/3 of your money is going to create income, and we can be more aggressive on the third that you don't care about. That doesn't matter if it goes up or down, because you're not taking monthly income out of it. You're not paying your bills with it. You're using that as maybe legacy money or future long-term care insurance, or something that can be a nest egg that's not going to go to zero, but it could go up and down significantly in any given year. But if you've got $1 million or $2 million and you can create $100,000 or more in guaranteed income, and that pays all your bills, then you can pretty much set it and forget it from the standpoint is not worry about your assets. Now, when we manage money, we worry about that for you. You know, if that's the case and you don't set it and forget it ever, you come in for annual reviews at minimum, maybe more if you want to, but just check it and say, hey, am I still keeping in with my plan? Am I still spending less than I make? Did I get enough cost of living adjustment on Social Security and my pension in order to make sure that I can still pay my bills? Do I want to take some more risk now that the market corrected? We can do different allocations, different risk assessments, and see if you want to take more risk, less risk in your investment portfolio. Double check, make sure that that income that's coming in is still paying the bills. And if not, then we can turn some more of your savings into income, or take some more of those profits off the table if you've had a really good year. Talked to somebody that has seen a portfolio go from about 400 to about 800,000 in the last 5 years. They're pretty happy about it. Guess what? Their fixed income isn't giving them everything they need. So we can take the profits off that. They still are no worse off than the 400 they had a few years ago. And now they can get another $30,000 a year in income from that based on their age and based on what's available to them. Just one case that comes to mind. But you never get hurt taking profits. And if the market does well, take those profits and create more guaranteed income, and then let the balance ride and create some more. And if the market goes down by half, you basically took all your profits back. And if it goes by half, that 400,000 profit is now only 200, but it's all profit. It's still profit. And you still have income from that part that was profit. But if you go from 400 to 800 and back down to 400, that just kind of seems like a boring ride. That seems like, man, that's a bummer. I wish I'd have taken profits. You look back and say, wish I would have, could have, should have, and you didn't. So now we have to wait it out, and you're kind of bummed. So you never get hurt taking profits. You never get hurt looking at your assets and making sure you have enough income. Those set it and forget it asset classes are available. Unfortunately, I think the set it and forget it that you were talking about is the typical person that got there through stocks and bonds and think they can continue to ride this retirement, sail through the retirement waters with the same investment plan, with the same thing that got them to there. I guess I just came up with another kind of an expanded analogy. If getting to the ocean, you have to drive across country in a car, that's your retirement savings. And you drive a car to get there, and then you retire and you want to go out and sail off into the sunset of retirement. You can't keep driving your car. It's a different thing. You got to get a different vehicle. You got to jump on the boat because that's what gets there. Do you want to drive your own boat without a map, or do you want to get a map and have somebody that's driven that boat steer it for you? That's what we are. We're the skippers of the boat. We've been driving the waters of retirement for almost 40 years now, and we know where the obstacles are. We've learned about new routes and new things to take, new tools, new ways to be comfortable on the boat, and more ways to not fall off early or not crack the boat and have your retirement plan spoiled by accidents that could have been avoided. So again, it's one vehicle that gets you to the port. It's another vehicle that gets you onward and through the retirement years. The set it and forget it strategy could still be employed. You just need different tools, different vehicles in order to make it work.
So, Jeff, as I said, the biggest fear people have is running out of money. How do you plan for a retirement that could last 30 years or more?
Well, again, it's just all about the income. Reiterate the same points as I've made a couple of times today, and that is, how much of your investments can you afford to lose? Well, let's not put those in the market. How much income do you need to make your life comfortable? Well, let's make sure that we buy your own private pension, whether it's a tax-free pension through LERPs, whether it's a Roth IRA with an income rider that's tax-free, but could run out of money, but you still get to leave the balance to your heirs. Or it's just an income rider from an IRA that could be taxable, but at least you know what it is every year, every month, so that you know what to plan for tax-wise with the other money. Again, it's just all about, do you have enough income that's guaranteed to create that peace of mind? Income is king in retirement. That's all there is to it. I know Wall Street hates to hear people like me saying that because they want to make fees on all the money. Now, hey, we don't mind the fees we make on our managed money. We think we do a good job with it and keeps the lights on and keeps the bills paid around here. So it's important. We get that. But if we can make your life a lot more comfortable by creating income streams that we don't get ongoing fees for life on, that typically a company would just pay us for setting up and it's one and done, but it creates the mindset that you don't have to worry so much about the other money. And I think clients are stickier if they have that peace of mind knowing that their bills are paid and they don't seem to be rocked too bad, because I don't get a ton of calls when the market fluctuates or when a war breaks out in Iran or when the market sells off. It's not a big deal. It's like, oh, well, I've still got my income. I've still got my other money that's safe. Things will come back and I can wait on this money. And the truth is, the market does come back, but can you wait on the money? Is it money you need to spend every month, or is it money you can truly wait on? If it is, then you've got probably the right risk allocation to the market as opposed to income. Some people just hate risk altogether. Some people had risk and had income, and because they don't like how risk affects their other money, they just decided, I don't want it anymore. I'm done with it. And that's fine too. There's safe ways to still be in the market, keep your money liquid, make a reasonable rate of return that'll keep ahead of inflation, even on short-term bonds nowadays. So far, inflation has been in check for a couple of years and interest rates are still relatively high, keeping up with it. So you don't have to take a lot of risk to make ends meet and to keep ahead of inflation or keep up with it. But I don't know if that's going to be true forever. And that's why I still like at least a little bit of money that we can grow faster than inflation, so that if inflation does take hold and the market doesn't do well, that we still have stored a few of the profits along the way for those rainy days ahead.
Great conversation, Jeff. Appreciate your input on this. I want to be very clear to our listeners. Retirement is not a set it and forget it situation. If you haven't updated your plan in the last year, you're already behind. And the danger, well, you won't feel it right away. It shows up slowly. Higher taxes, rising healthcare costs, and a market drop at the wrong time. And suddenly, the income you thought was solid, well, it isn't anymore. And that's how people run out of money. If you save $500,000, $1 million or more, this is your moment to get things right. Call 520-780-9059 and get your Premier Retirement Roadmap at no cost and no obligation. It's 520-780-9059. We'll show you plain and simple whether your income is protected or is it exposed. Again, it's 520-780-9059. You can also find out more about us online at primrent.com. Don't wait for a mistake you can't recover from. Jeff, out of time for this week. Thanks so much for your time. But again, I want to thank our great listeners here in the greater Tucson area for joining us. So for Jeff Vogan, I'm Jeff Shade. Have a great weekend. We'll talk to you next week right here with another edition of Premier Retirement on 790 KNST, Tucson's most stimulating talk.
Investment advisory services provided through Premier Wealth Advisors, LLC, an Arizona state-registered investment advisor. Securities transactions are placed through TD Ameritrade. Insurance and annuity products are offered through Premier Advantage Inc., DBA Premier Retirement Planning and Wealth Management. Investing involves risk, including the potential loss of principal. Any reference to protection, safety, or lifetime income generally refer to fixed insurance products. Insurance guarantees are backed by the financial strength and claims paying abilities of the insurance carrier. The show is intended for informational purposes only and is not to be construed as advice or recommendations. Due to show format, accuracy and completeness cannot be guaranteed. Premier Retirement and its representatives do not provide legal or tax advice and may only conduct business with residents of states and jurisdictions where they're properly registered.